Question of the day. How can you be certain as a trader that this is a bear market? Answer is simple. When you keep buying the dips, when everybody keeps telling you, buy the dip, and you keep losing money, that's how you know for a fact that this is a bear market. We're going to show you specifically what's about to happen and why. And the question on everybody's mind is, what will the Federal Reserve do tomorrow? We're going to answer that for you. The second question that should be on your mind if you're a trader, if you're a stock trader or an options trader is, how do I trade that reaction? How do I make money with what's going to take place tomorrow? And we're going to share that with you. For those of you that are longer term investors and you're wondering, well, how does tomorrow interest rate decision announcement is going to impact the market longer term? Like not just tomorrow or the next day, not just this week, but how will that impact the markets going into the next 30 days or possibly into the next few months up to a year? We will give you the answer to that. So here it is. A few charts pointing to no further rate hikes, or specifically what they're pointing to for a fact is a decrease in the number of rate hikes. So the two possible outcomes tomorrow is this. The Federal Reserve will not raise the interest rates tomorrow. It's going to wait. Now that actually has a lower probability of happening compared to them actually raising the interest rates tomorrow. But with that, projecting the future interest rate hike increases to be of much lesser amount, or possibly none, or possibly they're just going to say that, okay, we're just going to watch the data. All of that is represented in these few charts. There's actually a lot more, but for the sake of making this video like no longer than 30 minutes or so, all right, here's just a few charts. Okay, what you're looking here is a US dollar chart. The dollar does not drop on higher rates, okay? It only drops if the rates go lower. So this chart right here in the dollar tells us that the dollar is topping. In other words, you've probably heard in the news everywhere, oh, the dollar is so strong, it's so strong, it's so strong, it's hurting the U.S. economy, it's doing this, all that stuff. Okay, well, the dollar is stopping. By observing this chart, okay, yeah, dollar is in a very bullish trend, okay, but recently a lot of people have been taking the profits in the dollar, especially recently going into this Fed rate decision announcement. So the general relationship between the dollar and interest rates. If interest rates go higher, the dollar becomes stronger. So just remember that. So if everybody thought the interest rates were indeed going higher, then nobody would be selling the dollar going into tomorrow's event. Everybody would be buying the dollar. But that's not what we're seeing. It looks like everybody's getting rid of the dollar. Chart number 2. Gold chart is exactly the opposite of tech charts, meaning it's bullish. As you know, we've predicted very accurately that all the FANG stocks and the NASDAQ stocks, and we've done that call over the course of the entire summer when Amazon was hitting 2000, 2050 levels. A lot of basically technology stocks were at their all-time highs. We said, look, short them. And it sounded like a crazy call at the time. Probably not as crazy as we call we've made on Bitcoin last December when it was at 18,000. We said that by this December it was going to hit 3,000. What we're seeing in the gold chart is this. Look at it. Look at this trend, right? It's a super bullish trend dating all the way when gold set a low in August. But look, for the same time, okay, that just as I pointed out in the dollar chart, okay, this is actually a very, very rare situation because generally when dollar moves higher, gold moves lower. Well, in this case, we have a situation over the same amount of time where dollar's been moving higher and it's just beginning to sell off, and gold is actually moving higher at the same time. It's supposed to be going lower, but it hasn't. So gold's been uptrending as well. Gold has an inverse relationship with the interest rates. If interest rates move higher, then gold is supposed to be dropping. And if rates go lower, then gold is supposed to be going higher. Well, in this case, clearly, the investors' expectations are such that they are expecting the rates to decline. And by the way, we have made the call on the decline of the interest rates About 2.5 months ago, I posted a video on this channel about predicting deflation or stagnation, and I broke down specifics why we believed. And at the time, it was a controversial statement because everybody, all they could talk about in the general media was how the interest rates were going to go higher, how scary it was. Okay, and we were saying that the interest rates were going to go lower about 2 or 3 months ago. So actually, it should be, I'll post, if you want to review that video, I'll post the video at the end of this one, so you'll be able to check it out. So, two charts, right? And both showing the expectations that, in this case, dollar's dropping. If they expected higher rates, then dollar would be going higher. And in this case, if they expected higher rates, then gold would be falling, but gold is going higher. Okay, so the third one, I mean, that's an easy one, right? If you understand the first two, you should understand this one. Bond prices rally. It's an exact mirror of the gold prices within the same time frame. So within the same time frame, what's happening? Treasury bonds are supposed to be dropping if the interest rates are going higher. Well, clearly, in the expectation of lower rates, the bonds were actually rallying within the same time frame. So we got bonds going higher, gold going higher, dollar going lower. That actually tells us that the expectations are such that the interest rates will go lower, not higher. Again, we're not saying that there will be no rate hike tomorrow. There's actually a higher probability of a rate hike tomorrow rather than not. There's probably a 65% probability there will be a rate hike tomorrow, with an announcement that there will be no further rate hikes, or maybe instead of the 3 expected rate hikes, there's only going to be 1. Now, there's a 35% probability that there's going to be no rate hike tomorrow, with a careful monitoring of data for future rate hikes in 2019. So you're going to say, well, if that's the case, I mean, isn't the stock market supposed to be going higher? Whoa, hold on a second. If rates go lower, doesn't that mean that the stocks are supposed to be going higher? You're right. That's generally the case, but not this time, buddy. Okay? Don't discount, with that being said, however, that if such announcement is made in either fashion that I just described, that the market is not going to initially go higher. And as a matter of fact, we're predicting that this is exactly what's going to happen. If such announcement is made, we're expecting the markets to initially go higher, followed by a sharp sell-off. So at 2 o'clock tomorrow, that's exactly how we believe the chart is going to look. Now, if you've been following some of our videos and strategies, we've been unanimously in favor of shorting every bounce. So in other words, when stocks go higher, you buy put options. And so since this bounce is going to be short-lived, just like every bounce that you have witnessed over the last few months, the same strategy would apply. We're not changing the strategy. Here's what's interesting, right? So you would think that if interest rates go lower, then stocks go higher. Well, clearly, as I've shown you in the previous charts of the dollar, gold, and bonds, everybody is expecting lower rates at this point. So if everybody's expecting lower rates, the general understanding would be lower rates should produce higher stock prices. Then why do we have this chart right here? Now, this is a chart of S&P 500. So in the same time frame, since I've shown you dollar began to top and begin to drop, gold has been accumulated by most of the institutional investors and is creating a really nice uptrend. Bonds are moving higher in price. Okay, why do we have the stock market actually dropping? Well, S&P 500, I think, is a pretty good illustration of what the market is doing overall. You can certainly use, NASDAQ, a Dow Jones, a Russell 2000. Okay, you can check them out. All of their charts pretty much going to look like this. So if indeed, which we have established based off the action, everyone was expecting, and everyone is expecting the interest rates to go lower. Why is the stock market dropping? Apparently, because a simple pause in interest rate hikes will not save the markets. Not this time. And any sign of Fed weakness, such as them going along with Trump pressures and either slowing the rate of the hike increases or actually not announcing the rate increase tomorrow at all, will be interpreted as an acknowledgement of the weak economy. Basically, the Fed is in a checkmate type situation, so no matter what it does tomorrow, we could see easily an initial spike followed by a sharp sell-off, either by 4 p.m. or by some point on Thursday. So let's take a closer look. Last 10 years, what have we had that propelled the stock market higher? Completely artificial environment with what? What are the characteristics? Lower interest rates, the lowest interest rates in the history of the United States. Lower taxes. Since Trump became the president, the markets got another boost. So lower rates, you're utilizing monetary policy. Lower taxes, you're utilizing fiscal policy to boost the economy. On top of that, billions in the stimulus package over the last 10 years. Now, here's what we've got now, and that explains why even if the pace of the interest rate rises, hikes is going to slow down, the market is not going to react favorably. So here's what we've got now. So now the Fed is actually unwinding the billions of dollars in the stimulus package. Okay, now you're in a situation where you can't lower taxes by a whole lot more. Okay, you also can't lower interest rates much lower either. So you can't really use the fiscal policy, you can't use the monetary policy, and you're in a situation that you've promised to unwind the stimulus, and technically speaking, that's what they're doing gradually. So unless we see maybe a situation where they say, okay, forget about unwinding the stimulus. We're going to introduce a new stimulus package. We're going to further reduce taxes. We're going to further drop the rates back down to zero, maybe negative. This market does not have a chance to sustain a rally. And here's why. Okay, the artificial economy that was created cannot survive in real economic conditions of this business cycle that we're heading into. So it absolutely has to have a further dosage of the drugs it's been using. But at this point, they are decreasing the amount of drugs that they've been given to the economy. At the exact point when the economy needs the highest possible dosage of drugs one can give it and supply it with. Here's the deal. An official economy was created by artificial stimulus. Point number one, fake boost in the demand or consumption. In other words, the reason why the GDP started growing in the first place was created through monetary policy. So clearly, if the interest rates were 5%, you wouldn't go get a car loan. But if the interest rates are at zero, you may consider going and buying a new car. Now that's cool. That's a great incentive when you're going from a higher interest rate environment into a lower interest rate environment. The same thing would be applicable to, at a lower rate because you're renting and your rent is $1,000. If you can go get a mortgage at $1,000, you would be more inclined to do that. And with a higher rate, let's say the mortgage would have been $1,350. Well, because of the lower rates, now you can get a mortgage and own a house, or what's called owning a house. You still have a payment on it, right? But it would be the same as renting, so it kind of makes sense. Again, it works for as long as somebody is able to improve their situation. Now, you can no longer do that pretty much with these big ticket items, right? You can no longer do that with credit card debt or student debt, right? Because main thing that you're buying it with, whether it's the car or whether it's a home, by the time you calculate the interest rate and the newly inflated price, because clearly the prices on housing have gone up significantly in the last 10 years. So now you may be looking at a still pretty low interest rate, but by the time all's said and done, when you look at that monthly payment, it makes no sense to pull the trigger and get into this situation where you're buying a house because it's no longer as great as incentives. See, when you have low interest rates and low home prices, then it propels the consumption and the demand for goods like cars and homes and, finance and electronics and things like that. When you get an introductory rate for a year on a credit card at 0%, you're more likely to take them up on that offer than if you were to get a credit card offer in the mail that said maybe an introductory rate for a month or 3 months. It makes sense to get a student loan when the cost of education is, $20,000 for 4 year. Now, it does make sense to get a loan and finance it even at a lower rate when the cost of education has gone up to 100 or 200,000. So hopefully this makes sense. So in other words, when you transition in from high rates to low rates and the prices are still low, it does create a very beneficial impact on the growth of the economy and consumption and demand, and it propels more businesses to open and produce. Okay, it does not work as good when you have been in that environment for a substantial amount of time, in this case 10 years. And so now people are used to these low interest rate environment. The main issue is this: when people get used to it, it no longer works as stimulus. In other words, over the 10 years, maybe the last car you've purchased was at 0% or 3%. So since the rate's gone up and also the price of cars has gone up, now you're going to go, and the chances are that you're going to get a lower car payment are next to nothing. Why? Well, because chances are that the last car you purchased, you bought it with zero down, a very small down payment, because that's how they got you into the dealership in the first place. Zero down, zero interest, blah, 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 right? So you went in, you got yourself a car, you didn't put any money down, okay, you financed it at a low rate, okay, but since then the prices on these cars have gone up because you probably financed the car instead of the conventional 48 or 60 months, you probably took out a loan on 72 months, what you still owe on that car now is more than what's it worth. But now the interest rates has gone up, so you try to go and trade in this car. Well, they tell you, well, it's worth less than what you owe on it, but the interest rates are higher now, so we got to roll in your what they call negative equity into the new loan, okay? But you also got to finance the already newly inflated price of the car you're buying, plus you got to carry into it the negative equity, plus you got to finance it at a higher rate. See, math just doesn't work. You're not going to get a lower car payment, period. Okay, same thing with the house, right? You want to get out of your current house, you want to buy a bigger home, that opportunity to do that with the least amount of cost and most incentives is just not there. The rates have gone up. You can't refinance it at a lower rate. Therefore, your payments is destined to go higher in any real estate transaction. Mainly is because the pricing of housing has moved up substantially as well. Okay, so I hope you understand this concept right here. So the boost in the economy, yes, it worked for some time, but it is no longer working because the condition has changed. And anyone at this point that is going to go try, and purchase anything on credit, they're going to face a sticker shock, if you will, because if they're used to a payment of $300 on their car, now their payment is going to be $420. If they're used to a house payment of $1,200, now they're looking at a housing payment of maybe $1,520. Okay, and so for that reason, people are going to have more incentives to keep what they have. And what we're headed into is an environment where less sales are going to be made. So why do you think Wall Street is so worried about corporate debt? Well, the answer is quite simple. Okay, they've taken out all these loans, they've taken out all the credits to expand their business. Well, now the sales are slowing down. In the meantime, the second part right here that we're going to briefly discuss is the costs on labor has increased. So now you enter in a situation where the sales for businesses are going to decrease while the costs are pretty much at their all-time highs. What do you think that's going to do to the profits? Well, the profits or the profit margins are going to go down. So if that takes place, then the companies are not going to report as good of earnings as generally believed. So the problem with this is a lot of companies are going to be filing for bankruptcies, and the situation is so touchy that any deviation on the demand side is going to impact companies' ability to pay the debt. And so it is a huge issue. So how did the tax cut create such an issue? Well, tax cuts created temporary wage increases. I'm not sure if you remember, but when all the media was applauding the tax cuts and everybody was so happy, okay, when all the companies started announcing the minimum wage increases voluntarily, I might say, And that's the crucial point here, is that right after Trump decreased the taxes, a lot of major companies increased the wages that they started paying their employees. So those people that were getting paid $8, they increased their wages voluntarily to $12, to $15. I mean, recently you've heard that Amazon increased their minimum wages to $15 an hour. Now let's think about it. The person that was getting paid $8 an hour now gets paid $12 or $15 an hour. Does this have anything to do with the increase in the production of that particular employee? No. In other words, the employee did not do anything to increase that wage hike. Okay, it was done due to the fact that the companies had more money to spend. So they actually, what they've done is they voluntarily increased their costs. How ridiculous is this? Now, if you were the person that was getting maybe $8 an hour, now you're getting 15, you're thinking, oh, that is so awesome. I mean, I'm cool with that. I'm happy about that. Well, you're not going to be happy about it within the next 12 months, because here's the issue. Here's the bigger issue with this. What the companies could have done with this extra tax money is they could have actually given a second person a job, okay? But they didn't instead. And so if they would have given another person a job, then the production would have ultimately increased. But instead, they just decided to pay for the same amount of production, literally twice more in some cases, right? 8 times 2 is 16. So, I mean, if they increase the minimum wage to 15 from 8, that's pretty much doubling. In other words, they've agreed voluntarily to pay double for the same production level as they were paying before. Well, when the sales slow down, they're no longer going to be able to afford paying somebody $15 an hour. And so those people that got the wage but didn't increase their skill, that did not increase their productivity. In other words, if it was just a bare change from getting paid $8 to 15 without the employee themselves contributing to that wage increase, if it was just done due to the fact that now the corporations had extra money to spend and they decided to increase their costs, then that is not sustainable, because when sales slow down, and the sales are going to slow down because of the slower economic growth worldwide, particularly in China. I don't have the chart pulled up here, but Chinese economy actually hit the lowest retail sales number in 15 years, guys. I mean, that's pretty crazy. Since 2003. China is just a good example, but if you look worldwide, all over Europe, all over Asia, pretty much with just a few exceptions like Vietnam, right? You've got everybody's experiencing a slower economic growth. So if corporations that make sales overseas are not able to make those sales, it's also going to impact how many people they hire, not just overseas, but how many people they hire here in the United States, because overall, slower sales abroad will impact the bottom line here. And if the bottom line here decreases, then people will lose their job here as well. The temporary tax cuts created artificial increase in wages, which are unsustainable in circumstances when sales for the companies go down and they're forced to actually lay off people. Now, earlier I said, well, the $8 an hour person that got an increase to 15 should be happy, and they were happy. But indeed, they shouldn't have been happy at all, because before they had a job. Now that the corporation cannot pay them $15 an hour, guess what happens? They have to lay them off. Now, the person that had an $8 an hour job before, now they are going to be out of job, period. But think about what has actually taken place in the meantime. When you get a raise from $8 to 15, what do you think that person does now that they make pretty much double than what they used to? What do? They spend money. Hell yeah, they spend money. They go buy another car. They go buy another house. They go buy, they get another credit card. And maybe maybe they would have not gotten a credit card. Now they got 3 or 4 credit cards. And since they feel good about making $15 an hour, guess what they do? They go spend. They go spend that money, okay? They go spend that credit card money. So now they're in a situation where they think, okay, I'm going to make $15 forever, and they don't see the fact that they're about to get laid off. They've already maxed all that money out, thinking that everything is wonderful and nothing is going to change and everything's going to stay wonderful forever. Now that they're going to lose their job, what's going to happen? Are they going to be able to make their credit card payment? Hell no. Are they going to be able to make their car payment? I hope so, but there's probably going to be some slow payments. I mean, I sure hope they're going to be able to make their house payment. The first that's going to suffer is the credit card payments, right? Then the car payment, then the house payment. Who gets hit? Why do you think the banks have been selling off for so long? It's because of this very factor right here, that the banking sector will get hit. And even though we've posted in one of the recent videos, right, a very important comment on how all the institutional investors have been recommending you to buy banking stocks for the last 12 months, saying how great of a value they are. But in the charts before, we were able to point out how these very same institutional investors were actually unloading their positions. Okay, see, forget about Goldman Sachs and the scandal. The scandal just was revealed a few days ago, but they've been selling Goldman Sachs since it was $250, since it went down to $230. When it was at $230, what did they tell you? Oh man, it's a deal of a lifetime. Okay, it's it's the Gucci of the banking world. You need to buy it. Okay, so what happens to the Gucci of the banking world? Falls to 215, then it falls to 200. Now it's at 168, 170 range. Okay, and so they've been telling you to be buying this stuff while they were actually selling the stuff. If you have not seen that video, hey, I'll put a link at the end of this one if you're curious to find out some more details on that. Okay, so bottom line, here's the main thing. Okay, we've utilized the lower interest rates. The problem is people got used to it. So now any change as far as the rate hikes is going to completely shock the customer, and therefore it's going to shock the economy. It's going to shock the spending. People are going to be caught off with a surprise. They're going to be losing their job. The main issue with that is they're not even going to be able to get their $8 an hour job. But they've, in the last year, established such a lifestyle that requires a $15 an hour wage, which is no longer going to be sustainable with the lower sales worldwide, with the lower sales here in the United States. So because of the state that the consumer is maxed out, that by itself is going to diminish the sales here in the United States in the coming months, in the next 3 months, in the next 12 months. And so consumption will flop, and we'll be in a situation where we're going to be seeing massive layoffs. Now, we've been able to point some things out before they were taking place, and recently just, actually the previous video I posted a few days ago, we've been able to point a market move sequence according to our 13 market move formula that we're able to identify sequence 666, which actually was pointed out in that video on the S&P chart portrayed by these 3 candles right here. It was the same situation, or very close to the situation that we observed right before the drop, the major drop began right here on October 1st, right after October 1st, 2nd, 3rd. We were able to point this drop right here. We've analyzed the situation. We've pointed a few days ago that a bigger drop right here is going to develop similar to the drop. So let's take a look what happened. So today is the 18th, and so if we look further, exactly what our market move sequence formula predicted, this is exactly what has taken place. Now, that's not everything. The reason I'm actually pointing out to this chart is to just refresh some of your memory of what black candles mean. And so take a look at the black candle right here, see what happens after that. Consecutively drop 1, 2, 3, 4, 5, 6 days in a row, 7, 8 days in a row. Look what happens after this black candle right here. Drop, 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 3 days in a row, 4 days in a row, 5 days in a row. This black candle right here, 1, 2, 3. Now, look at this. We're getting another black candle. So if you look anywhere in this chart, if you see a black candle, okay, you will notice that it actually is followed by at least a 1 down day. And oftentimes, it will be followed by a few consecutive days lower. So we just had a black candle, we just got another one. That's not everything. I want to point out how consistent this has been. Now take a look at NASDAQ. We're not on S&P 500 anymore, okay? We're at NASDAQ now. Look at the black candle here. 3 days lower. Another black candle. 4 days, 5 days lower. Another black candle. 4 days lower. Black candle. 3 days lower. And what do you see right here today on the 18th? Another black candle. gives us a high probability that market will continue lower. If that's not enough, let me show you Dow Jones, December 18th. Check this out. Dow Jones does not have many black candles. Here's one actually right here. 1, 2, 3, 3 days lower. Here's one right here. 1, 2, 3 days lower. Here's a black candle right here. 1, 2 days lower. And guess what? Look at how consistent. Now, we're not just getting, sometimes we have instances where we'll get S&P showing a black candle, but NASDAQ or Dow Jones don't. I wanted to point out how consistent this black candle has been throughout any index that you look at today. So also, I think we are on the verge of the bigger drop because, observe this, see, the death cross is just about to take place right here on Dow Jones. Now, as you can see, we have not had a death cross anywhere else on this chart. Now, if we look at NASDAQ, the death cross has taken place. And since death cross, right, we've seen a small pop followed by a huge drop. Take a look at the death cross right here on S&P 500. See how precise this death cross was. Once the blue line crossed the orange line, the market just continued to drop. Okay, so we've got the death cross already taken place on S&P. We've had the death cross already taken place on NASDAQ. And we're finally getting to a moment in history where the death cross is going to take place on the Dow Jones as well. Now, here's very important fact right here. VIX chart has never looked more bullish, and it is on the verge of a breakout. Now, typically we talk a lot about bearish patterns and bearish signs of divergence and so on. On this chart, I'm actually going to point out a couple of bullish things. So as you can see, we have exactly the opposite of a death cross when the blue line crosses the orange line on the way up. So this is actually a bullish crossover. Now, also we have a pattern. You got to use your imagination here just a little bit, okay, as with any patterns. You've got a situation that is also known as a cup with a handle. And generally speaking, in most of the cup with a handle type of pattern formations, you will see a breakout anywhere to from 20 to 50% move higher. So in our view, this could take place anywhere in the next 2 weeks. We could see a move in the VIX of 20% to 50%. 50% move in the VIX will put us, close to 35, 40 on the VIX. Now, earlier, a month ago, we were posting the videos saying that the VIX could actually go as high as 80. And the reason we believe that, and actually, if you look back at that video, which was posted a couple of months ago, right? At that point, when we were recording this video, the chart was not yet pointing to this right here, this bullish crossover. The lines were just getting close, and we said, look, there's going to be a bullish crossover, and the VIX is going to move higher. The thing is, general environment over the last 10 years for the VIX have been such, as portrayed right here, where numerical value of the VIX has been between 11 and 15. And for those of you that don't know, the VIX is doing exactly the opposite of what the market does. So if the market drops, the VIX goes higher. Historically, numerical value for the VIX is low when it's between 8 and 13, and high, it's been as high as, almost 200, like 180 during the crash of 1987. Now, VIX, unlike any stock, it actually trades based off the rate of change. Based off the range of change and the fear of the investors alike, because investors buy options in S&P 500 to buy protection against the market drop. Now, very important thing to understand here, VIX has plateaued right here in summer in these low ranges, then it broke out. If you look at this breakout longer term from the standpoint, you will notice this other bullish pattern here known as a bull flag, where basically you have, this would be the handle of the flag, and this right here would be the flag itself, trading in the range between 18 to 25. Generally speaking, a bull flag formation leads to a further rise. So we've got what we're observing, a couple, the handle in combination with the bull flag, very solid base, out of which VIX should have no problem breaking out here. And also we're noticing a very bullish situation right here developing on the MACD as well. So how do you trade this situation? Tomorrow, when you see the market spike after the interest rate announcement, okay, the VIX is actually going to temporarily drop. When the VIX drops, you buy calls on the VIX because you can buy weekly calls. I wouldn't necessarily encourage you to buy next week's calls because you will lose some days because of Christmas, clearly. So maybe you can go and buy the first week of January, buy VIX calls, And based on these calculations right here, based off all the other charts we typically analyze, we're going to easily see a 50 to 100% move in the VIX. 100% move in the VIX would put us at 50. Do your calculations accordingly, but 2 or 3 weeks could be a nice payout right here on the VIX. So why so many professional institutional investors are hopeful of a rally? Well, maybe we should take a closer look at what they're actually saying is taking. Number one, it's the earnings, guys. The earnings, man, the earnings are still so good. Guys, come on, let's get real here. The earnings have been the best for the entire duration of 2018. Did that help the stocks go higher? No, it didn't. Then they scream the fundamentals, man. It's the fundamentals. The stocks are going to go higher because of the fundamentals. Dude, what fundamentals are you talking about? The fact that consumers maxed out? United States corporations are maxed out as well? Everybody's leveraged up to the moon? What fundamentals are you talking about? The fundamentals might have been at the peak, but you don't want to buy stuff at the peak. I know you were probably the same dude that told us to buy Bitcoin last December at 18,000. And now you're telling us to buy the dip. Hell no. Number 3, everything still looks good, guys. We're not in the bear market. Come on, it's going to bounce. It's going to bounce. Look, it's going to bounce. Everything is good. Look, hey, I heard one guy saying the market is going to rally 10% by the end of the year. Well, considering it's the 18th, we only got like 10 trading days. Apparently, I need to get some copies of the charts that this dude is looking at. All right, number 4. The markets have come down so much, they have got to come back up. I mean, are you kidding me? Look at Amazon. It's down 30%. I mean, look at some of these great stocks. Micron is down 50%. I mean, when something is down, when something is on sale by this much, well, certainly it's going to go higher. Guys, come on, let's get real. If that is the reason why someone should buy the stocks just because it's dropped, that's not a really good reason to buy anything, okay? You have to look at the context. Again, buying the dip is a good strategy when the market is in the uptrend and it's bullish market. Right now, it's not. So you don't want to just be buying something because it's on sale 50%. There is a reason why some stocks are on sale 30 to 50%. Number 5, Santa Claus rally always happens. Guys, we could have applied the same analogy to the Thanksgiving rally, or at least the fact that stocks generally don't drop a few days before Thanksgiving. But guess what happened this year in 2018? The stock market literally dropped over 1,100 points within 48 hours before Thanksgiving. That has not taken place in 10 years. What this tells us is that the market environment has changed. Not changing, it has changed. So this strategy of the Santa Claus rally is no longer applicable. And number 6, hey, we're hitting some major support levels and we're destined to bounce higher from here. Now, out of all of these 6, this is probably the most valid one because the support level is going to hold and stocks will bounce occasionally off of the support level. But I'm going to show you a chart right now, which is going to show you why the support level is not going to hold this time. So, by the way, you know who these institutional investors sound like that is still bullish in the market? They sound like Bitcoin hodlers. You remember what the Bitcoin hodlers were telling you? Remember when it dropped from 20,000 to 18, what did they tell you? Oh, buy the dip. Then it fell to 15. What did they tell you? Oh, dude, buy the dip, buy the dip. Hold on, don't sell it. What did they tell you? They kept finding reasons, all these goofy reasons why Bitcoin is going to go to 500,000, 1 million, and so on. So here's one major thing, right, is they were so bullish. I mean, this guy on CNBC, this Asian guy, right? I mean, Tom Lee. Yeah, this Tom Lee guy still thinks Bitcoin, his end-year Bitcoin target is, 15,000, and that's after he slashed it from 25,000. I mean, with Bitcoin being at 3,500 right now, I mean, these guys don't have a shot. Bitcoin is not going to go to 15,000 in 5 to 10 days, and here's why. because the chart is bearish as hell. Okay, so it was easy for Bitcoin to go from 1,000 to 3,000 to 5,000 to 7 to 8,000 because it was in the uptrend. See, stocks don't bounce 500-600%, or Bitcoin does not bounce 500-600% when it's in the downtrend, in a severe downtrend like that. See, once something drops like that, it's going to take it a lot more time to go back to the previous levels. Okay, so in this case, check this out. This is very important. You see these purple dots right here? Okay, this represents the many times Bitcoin has actually dipped to the level of 6,000. And I want you to observe very careful what happens. So this chart actually represents the entire time everybody's been a bull on Bitcoin while we were a bear. And people didn't want to listen to us at 18. They didn't want to listen to us at 15. I remember putting some alerts out here on this channel months ago when there was around 11, 12,000 saying, hey, get out of Bitcoin. And, you know, people would just add a bunch of negative comments and so on. And you know, people still think that, you know, I'm some kind of Bitcoin hater. Look, I study the charts, guys, okay? I have no personal preference towards Bitcoin or anything else. Much do I have towards Amazon or, you know, any other stock. It's just when the charts show you that you should short the stock, the commodity, the cryptocurrency, then you should short it. And when the charts show you that you should buy it, then you should buy it. So the time to buy Bitcoin has not come yet. Okay, but the most important part right here is this. Notice how the first time Bitcoin gets to the level of 6,000. Let me enlarge this a little bit for you. So, you know, I think this is a very important Bitcoin observation from Bitcoin chart. So the first time basically it falls to 6,000, look what happens. Look, it actually gaps up higher, bounces higher, and moves higher back to, like, you know, a much higher level, like 9,000, 10,000, right? So the bounce happens quite fast. Look the second time it hits the 6,000 level. Now, not only does it not reach the same level that it established from the prior bounce, it goes just a little bit higher from the 6,000 range, but also important to know the trajectory. See, it's not that steep, so it takes it a longer amount of time to hit a lower level. And the third time it hits the 6,000, look, here's what happens. Like, it's pretty much almost flat. Now, this is what this actually tells us. So the first time Bitcoin drops to 6,000, people get excited. Oh, yeah. Oh, my God. It's such a good deal, man. Let's buy it. Okay, fine. So people get excited. They buy it. The stock jumps. So oftentimes referred to a dead cat bounce, which is unsustainable. Okay, so that's the bounce you get first. The second time Bitcoin drops to 6,000, people are like, oh yeah, man, it's back at 6,000, buy it again, but not so many people are convinced, so you don't get as many buyers, and it takes a lot longer to bounce even to a lower level. Now, the third time it gets there, okay, people are like, okay, so what's the big deal? Bitcoin is 6,000 again. So people are not even in a rush to buy it. So when sometimes something trades at a higher level, okay, let's say Amazon, and it drops from 2,050 all the way to 1,500, what happens? Well, people get excited. Oh man, Amazon is one of the best stocks. It's been one of the best stocks for the last few years. Oh, it's on sale 30%, so it bounces quick. The second time Amazon drops to 1,500, what happens? It doesn't bounce as quick, and it doesn't bounce to as high of a level. And the third time it gets there, like, what's the big deal? Okay, so Amazon is back at 1,500. Almost nobody wants to buy it. So people are no longer perceiving Amazon as a great deal. And if they're not perceiving Amazon as a great deal at 1,500, it's the same story repeats itself. But we'll clearly see that story in the chart of Bitcoin. So people get excited. A lot of buyers come in. They perceive it as a deal. Second time, not as many people convinced. The less people perceive this as a deal. The third time, nobody cares. And the most important part is what happens next. And what happens next is this. Bitcoin falls from 6,500 to 3,100 in a matter of 10 days. That's what happens. Okay, now, I'm not saying the markets are about to get slashed in half, but this is what I am saying. Take a look at this NASDAQ chart. Does this remind you of anything? Well, it's the same thing, right? So first, NASDAQ dips to this level. Like, oh man, the technology stocks, they've been so hot, so they start buying them. It bounces quick. The second time, okay, to a lower level. The third time, the magnitude of the move higher is much lower level. So this is the fourth time. And what do you think is going to happen now? Well, in our view, this is going to happen now. Okay, so tomorrow, this is what the Federal Reserve is going to say. We're going to slow down with rate hikes. Market initial reaction at 2 p.m. tomorrow, December 19th, 2018, is going to be up at 2 p.m. So, check out your screen, maybe 205, 210. So the market's going to look like everything is in the green, and all the bulls, guys, all the bulls, right, that were telling you this for the last couple of months, they're going to be celebrated, right? All the bulls, all of our bull friends. That what are they going to be saying? Oh, dude, I told you it's the earnings, man. It's the fundamentals, man. I told you everything still looks good, okay? The markets have come down so much, they had no other way but to go up. And, of course, I told you about the Santa Claus rally, and I told you the markets never break their support levels. Yeah, they did so many times in the last 100 years. It's crazy. And this one should be no exception. So that's going to be the initial reaction. And the bulls are going to be celebrated. Unfortunately for the bulls, the market is going to wipe out those smiles pretty quick, because the true reaction of the market is going to be revealed by 4 p.m. So you will see a spike higher initially, followed by a huge sell-off. Now, the sell-off could be indeed ridiculous, like to the extent of maybe 1,000 points on Dow Jones. Now, I'm not necessarily saying that it's going to happen exactly to the magnitude I am describing, but we are predicting that the reaction is going to be like this. Now, if the magnitude of the reaction is not going to be as large, we are actually believing that the next day on Thursday, the stock could try to go higher one last time before a major drop. So be prepared for initial reaction higher, followed by a reversal lower. So a more important question is, what will happen after tomorrow? So after tomorrow, over the course of the next 30 days, expect a market correction of 10 to 15%. Hey guys, if you have any questions about charts, about our 13 markets move formula, if you have any questions regarding stocks, options, or financial markets, feel free to schedule a 20-minute complimentary trading options session where you will be able to ask any questions about trading stocks or options, or specifically if you're trying to figure out more information about how to trade weekly options expirations. So take action now, get all your questions answered so you can make the next year, 2019, your best trading year ever. Thanks for watching. I'll catch you guys in the next video.